Hey, everybody. Whether you're getting ready to get your first mortgage or you're a first-time home buyer, we're going to help you understand mortgages and mortgage terms. Hi, I'm Serge with FindMyHouse.ca and eXp Realty. And today, of course, we're joined with the always lovely Sheeta Metcalf, and she's going to help us with understanding some of these mortgages and terms that we need to know. So why don't we start with what is a mortgage and how does it work?
Yeah, so we'll go over the most common asked questions in terms of definitions that people typically ask. So what is a mortgage? So I actually looked up the definition online. The actual definition of a mortgage is a legal, so just note that word, a legal agreement by which a bank or other creditor lender lends money at interest in exchange for taking title of the debtor's property. So the mortgage itself is the agreement of the homeowner, putting up their title to borrow money against the house.
So basically saying that the house becomes a security for that loan.
The collateral, correct.
Mm-hmm. Okay. And how does mortgage work?
So typically with the mortgage, so again, it's because you're using the house as a collateral, you're basically the money that you're borrowing, whatever nominal amount, that amount is registered against your title, the deed of your house. And that's how a mortgage is securitized, right? So, but yes, and even the signed legal documents. So typically on a, when you're dealing with a mortgage, you're dealing with the lawyer who is, like signing in the end. They're signing a legal document with the lawyer, and that legal document is also registered on title.
Okay. So what types of mortgages are there? There are different types.
Yes. So the most common one is we call the term mortgage, is with, you'll borrow a nominal amount. And then that amount over, then you're paying back that debt and the balance decreases over time. So that's a term mortgage. So it's set with an amortization eventually over, your lifetime of the mortgage. The balance can be zero. Another mortgage product is the home equity line of credit. So the acronym HELOC, that's a HELOC, which is a massive, you know what I mean? Like it's just like a personal line of credit. It's just an amount that you could, I guess what you do is you can readvance and pay down, right? So you're able to use that, the equity of the home readily. So that's a home equity line of credit. That's another, mortgage. When I say mortgage product, it's because it's also registered against your house. Like it's mortgaged, right? It's that's leaned on your house. And the other one is a reverse mortgage. This is becoming more popular as we see our, baby boomers, aging, and sometimes they don't have the income. So a reverse mortgage is something where it doesn't require payment. And so what ends up happening is it's the opposite of debt being paid down. That debt is growing just because you're not making payments towards it. So it's just another product of like another mortgage product.
So in the reverse mortgage product, of course the people are taking equity out of the home in form of an income. But what happens at the end? Let's just say that they pass away. Does the bank then take over the property? Does the property go to the estate and the estate clears the outstanding balance?
It does go into the, so it essentially does go into the estate, but because the mortgage lender has their, loan against the house, right? So that becomes the person, just like if anyone else passes, there's a demand letter. So in that, once that security, right, the owner of the security is no longer around, then the debt has to be paid out. And where the reverse mortgage is different from your regular mortgage term is that, so typically when you get a house, the regular mortgage term is to pay down that debt. So then ultimately you're mortgage free, you're debt free. But with the reverse mortgage, because you can draw it out as income, you're not typically making a payment towards this mortgage, right? The mortgage accumulates, like the balance increases, right? So, but it is securitized against the house, and the equity of that home, right, does pay out that debt in the end.
Right on. Now, there's a couple terms that we always hear often when we're talking about mortgages, and sometimes people kind of confuse the two.
Okay.
And those the two terms, of course, are amortization and terms. So,
Mm-hmm.
could you clarify those two for us?
Yes. So when we say when I say amortization, and I say, an amortization is the entire life of the mortgage, right? So a life of a mortgage typically is 25 years. That's how long it's going to take you to pay off your entire mortgage. But in this 25 years, you can take contractual terms, right? So contract periods. So it's a 5-year term, right? Over that 25 years. So you can break it up in different contract times over the 25 years, because you don't have, you don't have one interest rate for the whole 25 years. You'll have one interest rate over the 5-year term, right? And then you renew into maybe another 5-year term or another 3-year term, right? So these are little small contracts, periods over the amortization, which is the life of the mortgage.
Right. So basically, um, I guess to simplify it, a term is pretty much going to tell you how long you're going to have a certain set interest rate for, the period of time they're going to have that interest rate for.
Correct. That's outlined
Yeah.
and defined. Yes, correct.
Okay.
Because the
And then
life of the mortgage is broken up into smaller periods.
right. You said that the most common mortgage is 25-year amortization. Is that the longest that you can amortize a mortgage over?
No, as of recent, we said as of recent, insured mortgages can go up to 30 years, right? 25 was typical. When I say it was typical, it's because back, previous to last year, December 15th, an insured mortgage maximum was 25 years. And so
Mhm.
now it's recently now expanded to 30 years. So I think, and I'm starting to see now, you know what, because of that change, I'm starting to see more 30 years, just because it's for the first time home buyer. Minimizing that payment allows them to get into a bigger home, and with house prices going up, it's so they don't feel the need, they're not priced out because they can afford the payments at 30 years as opposed to 25 years.
Okay. Now, let's talk about the difference between a fixed term mortgage and a variable rate mortgage. How do they
Mhm.
differ, and why would you want to choose one over the other?
So in those little contract times over the life of your mortgage, the type of, interest rate, right? The types of interest rate that's outlined in that contract term can either be fixed. So basically, fixed means it's guaranteed over let's say it's a 5-year term, like it's a 5-year period. It is
Mhm.
fixed. It's not changing, right? So you know what your payments are going to be for the next 5 years of this mortgage, right? So it, regardless of what Bank of Canada announcements are over the next 5 years, you are guaranteed that payment over the next 5 years. Hence fixed. Adjustable rate mortgage or variable rate mortgage, it's a floating rate, and so typically it's a rate that's combined with our prime, our Bank of Canada prime, and so that prime rate can either go up or down based on the Bank of Canada announcement, and the Bank of Canada will make announcements and they'll make changes based on their monetary policy, depending on how healthy our economy is. So that rate isn't guaranteed. So I always call it a floating rate. So in that 5-year term, your rates could be up or down. So it's no guaranteed. So that's the difference between a fixed and a variable rate mortgage.
So, what is the pros and cons of a variable rate mortgage?
Oh, yes. So obviously the pros of a fixed is guaranteed amount, right? A guaranteed budget that you know what you're going to pay. But the pros of a variable rate mortgage, because typically, historically, a variable rate interest mortgage has been lower, right? Has been lower and saved you more money. But the fact that right now, not so much, but we are anticipating a rate decrease. So historically it has been lower, and for those who are more risk averse, can benefit from, as rates go down, can have those cost savings, and know that, just have faith in the fact that over time they are going to be saving more on their mortgage in the long run. But it is riskier.
So,
It's considered riskier.
it's considered riskier because, of course, because there could be a fluctuation in those interest rates. The mortgage payments could fluctuate from month to month
They
based on
do.
the interest rate, which for some people that may make it a little more difficult to budget. And sometimes it's just having that locked in rate is just so much more secure, and you have, I guess, some comfort knowing that that's not going to change.
Peace of
But
mind.
if you, yeah, there's peace of mind. But if you were in a variable rate mortgage, and I should say, oh, you took a 5-year variable rate mortgage, and then all of a sudden you had a concern that, geez, I think rates are going to be going up in the future. Do you have the ability to lock in before the end of that 5-year term?
Correct. You can, so the word lock in really means you can convert your variable interest mortgage into a fixed mortgage, right? And then just lock that rate in. And so when I say convert to a fixed, so you're converting into whatever the fixed rate that that lender has on the time remaining. So, for example, if you take a 5-year variable interest rate and 2 years in, right, you still have 3 years left and your concern rates are going up, you can convert into the 3-year, whatever remaining term, the 3-year fixed rate being offered by that lender. So yes, you can essentially lock in or convert into a fixed term at any time. But it just has to honor, but you still have to honor the time of the contract, the time remaining.
Okay. Now, how long does it take to go through the mortgage process?
So when I'm essentially, if you're looking to buy a house, there's the process should be get a pre-approval, and a pre-approval typically can take. I mean, depending on, the process I have is I fill out an application online and provide me all the documents. And then so with the documents, once I have both in front of me, I can do my underwriting. It would take 24 hours to do my underwriting, right? If I'm submitting for a rate hold, it takes about 24 hours to get a rate hold back from the lender, right? So I could say, yeah, 24 to 48 hours if you want to go to the point where we need a rate hold. If we're going into an interest rate declining environment, essentially a rate hold isn't required, and I can do a pre-approval typically in 24 hours. And then the approval process, so a pending offer. So you've worked with me, Serge, right? So I mean, understanding the climate of the market right now, right? The multiple offers. So I mean, ideally, I would like my week, right? I'd say 7 days, 5 business days. The 2 days on the weekends allows me to work with clients to sign paperwork. The rest of 5 business days going back and forth with the lender, submitting documents. So I say a week, but you know what? If push comes to shove and I need to have a shorter condition period, I've turned things around in 2 or 3 business days if necessary, right? So
Right. Okay. Now, we're getting ready to think about buying a home, and we go, okay, I think we want to get a pre-approval. But one of the things that I could do before I even come to you is check my credit score. What credit score is required for someone to be able to qualify to get a mortgage?
Yes. So consumers can go directly to Equifax and order their own reports. So because I'm a mortgage broker, right, I have all access to all levels of lending, right? So your credit score 550 and under, like obviously that means it's blemished, right? That's private lending. That's interest, high interest and fees involved. Anything 550 to say 620, that range. I would be, B lending, alternative A lending, but B lending. So again, there'll be, it's a premium on the interest rate from prime, less than private, but it's also more than the prime side. And there's also a lender fee, but less than your privates. And then 620 and up, right? That's when you start going to prime. Prime is your banks, like your big 5 banks, monolines. And so we start at 620, but 620 to 680, I'd mentioned previously, it's satisfactory, right? So other areas of your application aside from credit has to be relatively strong. And 680 and above that's excellent credit, right? So that's pretty much the range for credit scores. And if you're trying to access different areas of lending, and if you want to work on that beforehand, yeah, that's the range.
So how can I know how much I can borrow?
Well, you're working with the mortgage broker to run the calculations. But essentially how we run the numbers is we take take your income minus whatever debt you have, right? Your obligations, your car loans, credit card balances. So it's income minus debt, and whatever's left over is essentially what we allow you to use to qualify for a mortgage. So whatever that payment you can afford will be, the size of the house you're going to get. So typically we always say if if you have a high debt load, you should try to reduce that, right? So whether it's paying down credit cards, lines of credit balances, or if you have car loans, right? Depending on, what those look like, right? I don't know, maybe if you, a broker can run numbers based on what you currently have. And then sometimes if we can, we'll let you know what you need to scale back on in terms of debt to qualify for or a specific property so that you can tailor your debt so that then it debt services to buy the house that you want. So we can reverse engineer, what do you want and what you need to show us in order for you to qualify. So sometimes it requires a client to go and with their vehicle, go back and, trade in the vehicle and get a lower payment or refinance the vehicle. So there's different ways to go about reducing debt, but work with a mortgage broker to qualify, to work on, figuring how much you qualify for.
Mm-hmm. And how much down payment is typically required?
So owner occupied. So the intention is to occupy that property. So whether you're a first time home buyer, even if you're buying, your upgrade property, right? If your intention is to live in the property, it's 5% down minimum, under 500,000. Anything over 500,000, it's your 5% on your 500,000 and 10% on the remaining for it to be insured. And then if you're buying an investment property, that's 20% down minimum.
Okay. Now I decided, yep, I think I want to buy a house. I am going to get pre-approved. I'm going to call a great mortgage broker like Cheetah. What documents do I need to have for you to get started?
So income being the size of your mortgage depends on how much you make. That's it. There's a direct correlation. So income documents are required, and that's standard, right? If you're an employee, so letter of employment, pay stub, and 2 years T4s. Sometimes, we can use the average of the 2 years if it's a higher income, or if your income currently is higher than your last 2 years, we just use your current income. So just providing the income documents and then is important. And then down payment, your source of your down payment matters as well. So mortgage lending is highly, highly regulated. I know that it's one of the topics I've had with colleagues and, different, areas of lending, financing for vehicles or houses. Mortgage lending is highly regulated. Source of down payment, we have to check bank statements and source large deposits. So I think we have a lot of compliance, right, to meet. And so income and down payment documents are what's required for a purchase. And then if you're refinancing, the income documents, because essentially you don't need to prove down payment. The equity of the house is your, the funds for the down payment.
Okay. Now, is there a difference between pre-qualified and pre-approved?
Mm-hmm. So when clients are, I guess when your clients are working whether with a broker or a banker, and then they see an email or a letter written from their broker or banker, and it says you are pre-qualified, right? So qualification is an easy ability to run numbers into our system, right? We don't need to check paperwork, right? It's usually you're qualified for this much, but you don't, even if you're qualified for a credit card, you usually get these offerings like, hey, you're qualified for, right? You didn't show much, right? So it's not underwritten. Typically it's not, they aren't asking for documents and going through the process. So you can be pre-qualified, but that's simply, you're not going through the due diligence as you would with the pre-approval, because the pre-approval is the next step where, in my process anyways, when I'm doing a when I tell clients who are pre-approved, it's because I've already collected the documents, I've reviewed the documents, and if necessary, I send into a lender, have the lender review the documents as well with me. Some pre-approvals are underwritten. So it's another step to ensure that the due diligence is done up front, so that at time of, you're getting your mortgage approval, you're not, you know what I mean? You're not upset because, I guess a verbal, you mentioned you made a certain amount of income, but the document somehow didn't, coincide, right? Align with the income. And next, it's unraveling at the financing period. So pre-qualified and pre-approved, very different, because pre-approval means there's more steps and there's, more steps in screening.
Yeah, I mean, I've run across this many times when people were saying, "Oh, I'm pre-qualified." We go and try to buy a property, we negotiate, get an offer accepted, and then we try to process the paperwork, and then people end up being disappointed because they were actually rejected for the mortgage. Right?
Yeah. Correct. Yeah, I think what happened over the last few years when those apps came out, bank apps came out and said, "Oh, get pre-approved through our app," right? And do you know what I mean? You're basically inputting, information, and then the system computes, a number out. You're not submitting documents, not being reviewed, and sometimes, and I don't think the clients are. Do you know what I mean? It's not like they're not lying about their income. Sometimes they don't understand that maybe if you're self-employed, you can't use your gross income. It's net taxable income, right? What's declared. So it's just the fact that like it needs a little more, it's just not a matter of putting a number in, because sometimes the paperwork or the lending rules don't allow for certain incomes and clients just don't understand. And then you don't want to set yourself up for failure, because the fact that you're right in our kind of market right now, like these properties don't last. So you want to make sure that you're not setting yourself up so that your hopes are up and then you get disappointed.
So now we've gotten pre-approved, we've put an offer on the property, and one of the things that we have to think about are closing costs. So let's talk about closing costs, maybe.
Yeah, let's talk about closing costs. Kind of got expensive in the last year. Okay, so closing costs on a purchase, your inspection, right? So typically the realtors will set up an inspection, and so that what's an inspection run these days? $600, $700?
Oh, it can vary. Again, it's a little cheaper for some condominiums. Some inspectors charge a little less for condominiums, but typically, I think what you're going to see the average being right now for a single-family home under 2,500 square feet or so is probably going to be between $550 and $650.
So then you've got, and I bulk in closing costs are kind of like costs that come into the purchase, right? So it'll be your inspection, condo doc review companies, right? So if you're going to buy a condo, right, you need to have a set of professional eyes on that. I think those runs what, $500. Again, I'm not the one that sets it up.
Between 5 and 6, yeah.
Okay, and then your lawyer, the legal. So there's going to be two like with the lawyer. There's two costs. So when you're asking a lawyer for their cost, number one is what is the legal cost of like that lawyer, facilitating the transaction, right? So that's one legal fee. And the disbursements simply is, the cost of land title fees, right? To register on title, courier, all that other stuff that the lawyer has to kind of pay an expense on your behalf just gets billed to you. Those are called disbursements, because there is a cost depending on size of your house that you have to pay as a fee for land titles for registration, right? So all those costs of disbursements are what the lawyer will pay for you, and you just reimburse them. So
other than that, is there any other closing costs that they should maybe factor in and think about?
I would also, and I'm seeing a lot more of, it's property taxes. Okay, property tax adjustment. So depending on what time of year, and depending what time of year, and depending if the sellers are paying the property taxes directly to the city, sometimes just be mindful. You may have to bring some money into the office, the legal office, if the seller has paid the property tax for the entire year, right? From January to December of that calendar year, you have to reimburse them if they're not occupying that calendar year's time, right? So depending on what the seller has done with the property tax and how they manage that could be a cost to you, right? When I say cost, it's your responsibility anyways, but these are just extra monies that you keep aside just so that, you know what I mean? Like your transaction or your purchase doesn't get hung up at the lawyer's office because you're short money.
Right. Okay. So something else that people don't quite understand when we say, "Oh, you may have to have mortgage insurance or default insurance. And they think, well, I'm already getting insurance for my home. This is not for their home, is it?
It's yeah. So default insurance. Okay, so when you're buying a house, there's insurance for. I guess there's insurance to cover everything, but mortgage default insurance is required in Canada, regardless of any financial institution. You are required to pay default insurance if you put less than 20% down. If you have more 20% or more, there's no need for default insurance because there's enough equity. Your down payment, that 20% is enough equity in order for the banks to feel comfortable to lend you money. And if they ever have to foreclose, they know that that 20% is enough of a buffer to recoup their cost, right, of foreclosure and getting back their secured back their loan or debt that they lent you, right? So, but if it's less than 20% down, it has to be insured, mortgage default insured, meaning that this insurance is a government insurance that protects the banks. It is your cost, but it's for the banks so that the banks are comfortable in lending you money so that they know that if you foreclosed, that if they had to, sell your house, recoup their costs, and if they're short, this insurance pays them out. So it's one of those things where if you don't have 20% down, you want to buy a home, then you have to pay that insurance. But that insurance actually protects the banks. It's government insurance as well.
Okay, so when it comes to that default insurance, that premium, is this something they pay monthly? Is this a one-time fee? And does that fee vary for any reason?
Yes. So it's a one-time premium, and it does change depending on your percentage of down payment. So if you're doing 5% down, 10% or 15%, the percentage of that premium does decrease with more down payment because there's less risk, right? So and also it is a one-time payment. So what ends up happening is it's not out of pocket. Borrowers do not have to, pay it. Essentially, your down payment's your only requirement and your closing costs. The lender will lend you that money. They just add it on top of your mortgage balance. And so that when we do a calculation, so I mean, any broker that's been in the industry, for at least a year, has done some transaction, that premium's already added onto your mortgage, that when we compute you a payment, it's already at, that mortgage balance, it's already inclusive of the CMHC premium or the default insurance premium. And that is just then end up being paid out, you know what I mean, as you're making your mortgage payment.
Okay. Now, let's just say that for whatever, I got lucky. I all of a sudden found some money and I wanted to pay off my mortgage. Maybe I won the lottery. Who knows? I know I didn't win, but maybe somebody out there won their lottery and can pay off their mortgage. Are there any restrictions to paying off their mortgage?
Yes, there is. Yes, there is, depending. And you know what, rather than saying yes, it depends. It depends. What does your mortgage contract stipulate? So there are two types of ways that I guess your prepayment terms. So basically, your ability to pay off your mortgage, right? Is it open or is it closed? If it's an open term, meaning, so open simply means there's no prepayment cost. Right? If your mortgage, home equity line of credit is considered open because there's no penalty to pay all of it off at any given time. Whereas most mortgages, right? Mortgages they're closed terms. And when there's a closed term, it means there's a parameter as to what's allowed to be paid down every single year, right? So, and if you, depending on the parameters, right? So most often your prepayment privilege, right? Because it's a closed mortgage and your prepayment allowance is 15 to 20%. If you're paying your balance is more than that, you are now penalized. There's a penalty for what's owing, what you're paying out and what's still owing.
Okay.
Right. So then,
yeah. Now, what happens if I miss a mortgage payment? I broke my leg. I couldn't work for a month. What happens?
You missed a mortgage payment. Well, the advice is don't. If you if you're late, well, if you end up missing a mortgage payment and you're late, it's a delinquency that's going to be reported on your bureau. And if that one payment goes, to 90 days, then it would set off the foreclosure procedures. You're going to get a demand letter. So typically what ends up happening is, you're going to get, so it's going to show up on your credit report as a delinquency, which is not good. And then you're going to get a letter to get you to, to get paid up to date. You owe this amount, and that goes 90 days. Then it's you're getting a notice stating that yes, there's going to be foreclosure proceedings, and at that point, so the reason why this mortgage, right? Mortgage is legal. That this is what makes a mortgage different from any other securitized debt. So like your car is securitized because you take a loan against your vehicle, your RV or whatever, right? It's your travel trailer. It's securitized, but it's not a legal process. There's not lawyers involved. And to repo your car, repo your RV and your travel trailer, they don't need to go to court. Whereas in a mortgage default, a foreclosure, it is judicial. So the courts have to be involved. This is why this is like the mortgage itself is more, do you know what I mean? Like that's why it differs from other debts, securitized debts. And so, yes, foreclosure process where now, you start the legal proceedings and then it's taken to court. There's a redemption period here in Alberta. So it's a whole process. But yes, ideally don't miss your mortgage payments. Just know that it's all the data of any delinquency on any debt is collected on your credit bureau, and that delinquency on mortgage is not seen lightly by the banks as you're trying to borrow money down the road, because defaulting on a late payment on your credit card is seen much more lightly than missing a mortgage payment.
It's almost as bad as going through
bankruptcy or consumer proposal. Yes. So there has to be a reason. And yeah, banks don't, I've had some banks say, no, we won't lend, right? Like it remains on there and we won't lend. So yes, it definitely has repercussions.
Well, you brought up consumer proposals because I run across this from time to time. People says, oh, no, I didn't go bankrupt. I had consumer proposal, but that's not as bad as bankruptcy. And from where I stand, when I look at trying to get a mortgage approved, the banks look at them exactly the same.
The requirements are quite similar, right? It's viewed as being, the same. We call them, bankos, right? So we can recognize that a consumer proposal is still, you repaying the obligation at you still have an obligation that you're trying to repay at a lesser amount. In bankruptcy really is absolvent to absolve the entire debt. But the requirements for lenders is typically you need to, be discharged, 2 years, reestablish credit, and, the requirements to kind of redeem yourself afterwards, right? It's quite similar.
Okay. Can I have my taxes debited with my mortgage payment? Instead of me paying the city, can it be taken out with my mortgage payments?
Yes. So your mortgage payment is, depending on your frequency, is an automatic debit out of your account. Property taxes are also an expense of the house, right? And so those definitely, the banks can handle the collection of your property tax. So it'll come out with your mortgage payment in the frequency, broken down in this kind of same frequency as you set your mortgage payment, right? As a mortgage broker, my advice is I wouldn't recommend having your banks collect your property tax, right? Some lenders, some lenders give you the option and some lenders don't. So, but if the lender gives you the option, I always suggest setting up with the city of Edmonton directly. Just for the fact that, when you're up for renewal and you're trying to make moves with your mortgage, right? You're trying to switch different lenders. You're not dealing with the tax account and having to make sure that the tax account is redeemed and you're getting that tax account back into your possession to be able to forward to the, to the city, right? What ends up happening sometimes, if your transfer is not done properly, your property tax account kind of just gets paid out. And then if you have a tax bill coming up, you have to make up that money that's short for the tax bill. So just having it dealt with the city, just, you're not, as you're doing the moving at, renewal time, it doesn't become a factor that just you have to be on top of. That's just my advice.
Okay. Which is kind of interesting because so those of you who don't know, I started in the industry in 1985, and the common practice was that taxes were paid with your mortgage payments. You really
Sometimes
didn't
it's a
have the
requirement.
option.
Yeah,
Yeah,
yeah.
you
Some
didn't really
lenders is
have.
a requirement. Hmm?
You didn't really have the option, and back then the city didn't have a program where you could pay them monthly,
Yes, that's
which
true.
now they do, which makes it easier for a lot of people to make those payments.
Much easier.
Now, how do interest rates affect mortgages?
Interest rates. Well, interest is the cost of your borrowing and whatever that, because your mortgage payment is a combination of principal, so whatever, so basically the balance, right? A bit of what the balance is, and interest costs. Every single payment debited has a combination of both. And so where the interest percentage is, it affects how much of that cost, right? So it's essentially is, if it's a higher interest cost, then you have a higher payment, right? So mortgage payments are based on the size of your mortgage, and then the interest rate is the cost of it. So that payment has the combination of both. So that's why it's ideal to have a lower interest rate so that your payments are low. And that's why this 2000, when we had the COVID rates and what the lenders, much of the homeowners now are up for renewal and the interest rates are going to be near double, they're going to see their payments jump up despite their balances being lower because of the fact that, yes, that interest rate cost just got higher.
Yeah, one of the things that we haven't talked about really, and I think is worthwhile mentioning, is that mortgage payment frequency and how it can affect your mortgage and how quickly you pay off your mortgage.
Yes.
Let's talk about that.
Yeah, the frequency. So we've, if possible, right? So when we say frequency is, the options are you've got your monthly, you got your biweekly, and then you've got or semi-monthly. So the difference between biweekly and semi-monthly is biweekly is every 2 weeks, and there's going to be a couple of months that has 3 payments, right? And semi-monthly is always twice a month. So there's going to be the 1st and 15th every single month. So, and then there's your weekly. So the frequency, you can choose to accelerate your payments, right? So it's the acceleration that allows you to pay down your mortgage faster. So it simply means that you can set up your biweekly payment and accelerate it because you make that extra 2 payments every single year. So what it is, it's half of your monthly mortgage payments every 2 weeks. Because you have those 3 payments in those 2 months, that extra 2 payments essentially is what's paying down your mortgage faster, right? So typically when you set yourself on accelerated payments, right, and that's allowed on a biweekly and it's allowed on a weekly, then you can pay down your mortgage faster. And it's a small change. It's, many people don't notice in their, their biweekly or their weekly payments because it's just a small difference, but accumulated over time, it saves you years on your mortgage. So these are kind of the mortgages, it's a long game. It's a long game. So essentially just kind of, if you're going to make these little small tweaks that you won't miss that money, but it's going to be very advantageous for you down the road because again, you'd rather retire years of your, paid out years earlier than having to carry a debt for, an additional.
Yeah, I know that for me, what makes a lot of sense is the biweekly, because for most people, they get paid biweekly and they're going to have their mortgage payments coincided with their paychecks. And I know one particular case where they started out with a 30-year mortgage, and by going biweekly, accelerate biweekly, they would end up paying their mortgage off in 22 years instead of 30. And that I can't even calculate and think about how many thousands of dollars that they potentially saved just by going bi-weekly.
Yeah,
Now,
that's an aggressive pay down. But yeah, you're right. For some people, again, some small changes that they won't miss now that will make a larger impact over time.
Now, I remember, again, quite some time ago, I don't want to think of how long ago this might have occurred, but I know that we had looked at the difference that making bi-weekly payments and weekly payments, there wasn't a whole lot of difference between bi-weekly and weekly. And I think if there's not going to be that much difference, again, it might be just easier to go bi-weekly and have it coincide with your paychecks and have it where this is coming out every week, right?
Correct.
So, okay. Can I refinance my mortgage at a later date? And
Absolutely.
what are the challenges that may come up because of that, and why might you want to do that?
Yeah, so you can refinance anytime you have equity in your home. Refinancing simply means redoing your mortgage. You're taking the mortgage, it's in a current term right now and just redoing it. So whether you're taking out a bigger debt against your house, right, to pay it out, or you're re-amortizing, so you take your existing mortgage, and let's say it's only 10 years left, but you can't manage the payment and you need to extend that amortization out again, you can refinance and do that. So essentially you're just redoing your mortgage. You can do that at any time as long as you have the equity in your home. So the government guideline is you have to have 20% equity in your home before you can start accessing, you can refinance and access that equity. Anything, gone are the days that we used to be able to refinance back to 95% of the value of their home. They've scaled that back. I mean, at least 10 years ago, where you can go up to 80% maximum of the value of your home to access equity. And you can do that anytime.
So one of the things I'm kind of curious about, and maybe some people are curious about, is okay, well, I know that if I had a mortgage and I wanted to pay out early, I'm going to have a penalty.
Mm-hmm.
But now, if I want to refinance, am I going to be facing that penalty? And if maybe if I do it in a certain way, there's a penalty. If I do it in a different way, there may not be a penalty or a lower penalty. How does that work?
Yeah. So if you're in a term, and you have to redo your mortgage, you're essentially breaking the term, and then the penalties will apply. I know some lenders where if you end up breaking the term, go to a different lender, the full penalties apply. If you decide to refinance and stay with existing lender, there's going to be reimbursement of a little bit of the penalties. There's lenders will do it to replacement mortgage. They're within their own internal guidelines, right? They'll allow you to get another, with the same institution, depending on how much time remaining is on in the type of mortgage product, can get another mortgage to replace, and then that alleviates a large part of the penalty. So these are the certain kind of things where I think when you're dealing with a mortgage broker and buying a house, and if you think that perhaps down the road you really want to refinance, you want to access the equity of the house, having a conversation about which lenders has a replacement mortgage, right? And that could definitely be a conversation to have, upfront, and then just placing your mortgage at the right institution off the get, right? So because there's so many different lenders, they all have their own nuances and guidelines. So and as a mortgage broker, right, I think I do a pretty good job of probing clients and getting them to understand what their long-term goals are. But a lot of times it's like, I can only know what I can only know so much. So if clients have these big, these ideas down the road and what they want to do, always share that with your mortgage broker so that we have the ability to, do you know what I mean? To tailor it for you. So the more we know, the better your mortgage will be suited for you, right? So you'll pay more if you're going to be backpedaling.
Okay. Well, again, towards maybe possibly the end of the process here, what happens if I sell my house before paying off the mortgage?
Well, you have you can either if you're buying another house, you can port your mortgage. So essentially that's keeping the exact same terms, conditions, balance, whatever you have, and just taking it to another property. So there's no penalties. But if you decide that you want to sell your house, pay out the mortgage, right? And again, you're in a closed term, there's going to be, prepayment penalties. There's privilege. And if you're outside that, then the penalty will apply. So essentially, yeah. So at that point, it depends if you're selling and if you're moving your mortgage, or if you have to pay out prematurely, then you got to pay, that penalty to that lender.
Yeah, you brought up the idea of porting or moving your mortgage to your next property, and I guess we see that from time to time. But I think most often when we see that, someone's buying a bigger, more expensive home,
Mm.
and now they need more money. How does that work?
Yes. So it's so yes, if you're upgrading, if you're buying a new house and you're upgrading, so then what we just port, right? We would port the existing mortgage, and if you need more money, we just add in it. We would get a the new money, the additional money at today's current market, and then would just be a blended a blended rate, right? Add the two monies together. It's got to be a weighted average, and depending what the rate on the new money is, the old money, then you get a combination, a blended rate of the on that loan, right, on that mortgage,
Okay,
right?
but
So we call that a port
that's
and increase. So it's a port and increase is the term. If I
mhm,
had to structure a mortgage, right, an application for my client, if we're porting and we're upgrading, it'll be a port and increase. If it's a matter of a client basically empty nesters, or what, they're downsizing, so it'd be a port and decrease. So what ends up happening is, I'd port the mortgage over to the next property, because it's not as big of a house, and depending on how much we're like, you know what I mean, like porting over, we don't need all that money. Whatever we end up having to pay out, if it's within the privilege, no penalty. But if it's more than whatever the privileges allow, then there'll be a penalty on the what extra that we had to kind of pay out.
okay. Perfect. Well, I think we've covered pretty much all the basics, and unless there's something I forgot that you think we should talk about before we wrap it up for today.
No, that was just a lot on, yeah, terms and definitions, right? I think and next week we're going to be doing a topic on just I did chat GPT to see what is a common question. Sorry, I got a call coming in here. Common question that people ask, but I think next week's topics are like just the hot topics in the market, and some people just need some direction. So I think next session is going to be a good one to tap into. But yeah, no, I think that's it. I think I think we've gone over all the common questions.
Okay. Well, as always, Cheetah, I want to thank you very much for all your wisdom. And if you're out there and you're thinking about buying a home and needing to get pre-approved or pre-qualified, let's not get pre-qualified. Let's get pre-approved. Come give Cheetah a call. As you can see, your phone number there is 780-932-2225. And when you need a realtor, I'm here. I'm Serge with FlyMiles.ca and eXp Realty. Wishing you all a great day. Bye now.